Trump is back, and that means big money moves. But here's the thing. If you know exactly where to look, you can profit massively. And that's exactly what I'm going to be talking about in this video. I'll be breaking down which industries and which sectors, along with stocks, can profit massively depending on Trump's deregulation and financial policies, and how you can change your portfolio in order to profit during this time. Let's jump right in. So, first, in this video, I'm going to be talking about three things: the best sectors to invest under Trump's policies. So we're going to be talking about sectors. We're going to talk about some specific investment vehicles, whether that's ETFs or mutual funds, etc., that can really give you an edge during this time. And then finally, we'll be talking about how to manage the risks and actually capitalize on market volatility, because let's be real, with the tariffs that are going on, with different changes, deregulation, and certain agencies being potentially shut down, there will likely be market volatility, and we've already seen some of that this year. So with that, let us jump in and answer the question, why should you listen to me with Fiona? I've helped 453 millionaires build wealth, helped manage $600 million, and I practice what I preach. So I built my own wealth, and by 27, I was a millionaire. I went to Harvard, I went to MIT, and I'm a CFP with over 11,000 hours of studying, of course, along with 7 years of actually practicing wealth management. So with that, let's actually get started and understand Trump's economic policies. I want this part to be the foundation for you before we jump into the nitty-gritty and figure out which sectors, which industries, and also potentially which stocks would be best for your portfolio. So let's actually understand what type of economic policies is Trump known for. And you might know some of this, but let's actually get into some of the nitty-gritty. So the TCJA is the Tax Cuts and Jobs Act, which was initiated in 2017-2018. And one of the major things it did do was it reduced corporate tax rates from 35 to 21%. And that kind of did a couple of things. So I wrote some of these down here. First, it increased corporate earnings. Why? Because there were lower taxes, right? It reduced it by 14 percentage points, right? The corporate tax rates. So that means increased corporate earnings, which also relates to increased earnings per share, which then increased. The higher the earnings per share, the more you investors in general like that, meaning the stock itself or the company became more attractive for U.S. investors. So far, this specific reform, the corporate tax rates, has been a benefit. Overseas profits also essentially repatriating or like bringing back foreign profits at reduced rates, which then also resulted in stock buybacks, meaning that companies essentially bought back outstanding stocks and shares that you and I owned, which increased the profits, right? For you and me, we got money. It decreased the number of shares in the market. Why? Because if we're looking at it like this, there's the market, there's the company, and there's like a set number of shares in the market, and the company essentially pulls the shares back under its umbrella, right? So it spends money, it pushes money into the market, and it buys the shares back. What does that mean? Just based on the law of demand, right? This is the demand curve, this is the supply curve, this was the previous equilibrium. Well, the supply decreases, and that means the price, if we're looking at the price up here, the price actually increases, right? This was the former equilibrium. So equilibrium 1, equilibrium 2, that increases. Why? Because there's a decreased supply, right? Decreased supply means increase in prices. That's the general law of supply and demand. And that's exactly where we get the increase in earnings per share. And then that ultimately leads to higher dividends, more profits, more dividends. And then on average, I thought this was pretty interesting. Companies in the S&P 500 increased dividends by about 9% in 2 years, in the 2 years following the Tax Cuts and Jobs Act. So again, overall, it's good for the company in general and pretty good for the investors, right? So there is a pretty decent win-win here. I'm not saying everything was perfect, but there was a win-win, and that's also why we saw the stock market, right? If we look at the S&P 500 in general, it did have an upward trend during this time. All right, moving on. Deregulation. So what did we talk about with deregulation? Specifically, there's a point about the Dodd-Frank Act, which essentially increased the asset threshold for very important banks. So think JP Morgan Chase, et cetera. Like these are systematically or systemically important banks to the United States. If one of these failed, that would not be pretty good. I have a bank account at JP Morgan, for example, and you might too, or you might know someone that does. And if that bank fell and failed, that would be very, it would essentially create a contagion for the rest of the United States, potentially causing a domino effect. And we would not want that. So he increased the asset threshold. How much money do these banks have to have? From 50 billion to 250 billion, right? In case of a potential bank run, for instance, which would, all in theory at least, make these banks a little bit more stable, which would increase consumer confidence, which would ultimately have consumers put more assets with these banks. That's kind of the theory behind it. There's also less oversight and less compliance, right? And so the result here means lower regulatory costs. Why? Because there's lower oversight, lower compliance. It means an increased profitability for the banks. An increase in lending because, again, the bank has a little bit more power to do things what they want to do. And then regional and mid-sized banks, actually, they outperformed larger banks as a result. So this was a good boost for the smaller banks as well, especially folks like you and me could actually access things like lower mortgage rates. I certainly refinanced my house during the 2019-2020 period and was able to get a pretty good rate on my house from a very local bank. So that was good business for them and it was good for me. Some trade policies, just getting into it, I have a feeling most of you probably have an inkling about this, so we'll jump over this pretty fast. Protectionism, I think Trump is pretty known for protectionism. In other words, it's the America First policy. What does that mean? It really means focusing on domestic or American production. It focuses on domestic or American companies. So one of the things that at least during the first term, was reducing the U.S. trade deficit, right? So there was about $375 billion of trade deficit with China alone. And to combat that, Trump raised tariffs, and I think we are experiencing a proposal and will likely go through, or at least some of it, here in the near term, raising tariffs and essentially renegotiating trade deals to protect, and I would say the key word is protect, domestic industries, right? So again, this is where it goes back to the protectionism and the America First ideal. Encouraging domestic manufacturing. Again, domestic is very focused on America. So how was that done? By increasing the cost of imports via tariffs, which then, as a result, made a greater incentive for companies to produce goods in the U.S., right? Some argue this might have not been as helpful. Others say it was helpful, but these are just the facts, right? And then that ultimately increased domestic production, which in theory should have brought back more jobs, and it did. Again, there's pros and cons to everything. We won't get into that, but these are some of the things that did happen in the first term. Retaliatory tactics, we understand the tit for tat tariffs, right? That's just an example. If one country increases a tariff, Trump would do the same thing. This is kind of a tit for tat tactic. Tariffs on China in 2018, 25% of tariffs were put on $250 billion of Chinese imports. So this is what we talked about. Some examples of that include electronics, machinery, furniture, right? So these are just some examples. And so in response, we're talking about this tit for tat again. China imposed this retaliatory tariff of about $110 billion on U.S. exports. These are some examples. And so the outcome, as we saw, volatility, and that's also to be expected here in the near term with tariffs likely going through. The S&P 500 dropped about 6% after the first waves of tariffs went through. There were supply chain disruptions. We saw that especially with like the semiconductor industry. And then, this relates directly to the sector impact, increased costs, right, due to tariffs on semiconductors, circuit bonds. So a lot of the electronic pieces, they were very impacted, and we saw the trickle down effect of that throughout the next couple of years as well. And then finally, some winners I wanted to list too. So domestic manufacturers in general were part of the winning team. And then semiconductor companies that moved supply chains to Taiwan and South Korea, they could have also been seen as winners. So let's move on to the next section. Like how does this help you? How does this help your wallet and your portfolio? So I was looking at only a handful of sectors. What likely sectors are going to benefit? And I think one of the sectors is probably the energy sector. Why? Because there has been support for fossil fuel in the past, right? That type of production, reduced environmental regulation. So a lot of it focuses on reduced regulations, meaning chances are the energy sector will see some sort of boost. At least in the past it has. Opportunities in oil, natural gas, and coal industries might be out there as well. So that's the energy sector. The defense industry. So, there has been an increase in defense spending and arms deals in companies like Lockheed Martin, I think is a decent example. Boeing, yeah, technically, but I think Boeing has, and we've seen and heard about this before too, like there's something systemically wrong in the culture and in how I think the process is used to like actually manufacture parts. So Boeing might be a good example, but the company itself might need to refine some things. But so these are two examples of the defense industry. And these companies, they might see growth. But again, there's also other factors out there, not just the Trump policies. Infrastructure development. This is another one. As you might have heard, there have been quite a few plans for significant infrastructure investments, right? So partnerships with private entities, which could mean that, there's construction, engineering, or additional like similar sectors that might see some growth, again, in infrastructure development. And then financial services, because of deregulation efforts. Deregulation means lower compliance costs, in general, lower costs, lower oversight, which means banks might be able to, or in general, financial institutions might be able to benefit from that. And because they don't have to pay so much for this regulation and oversight, they might be able to give back some of the saved cost to the customer like you and me. So we might get lower interest rates on lending, we might get more lending opportunities, etc. So that is the thought process behind it. Again, it's more of a trickle down effect, but to be determined how this shapes out. And yeah, just like I said, increased lending and profitability for you and for the bank. So what are some investment vehicles to consider here? One could be ETFs, right? So sector-specific ETFs. I personally am positioned in sector-specific ETFs myself, targeting industries that we just spoke about, poised for growth, right? So again, this could be the defense sector. This could be the infrastructure sector. This could be the financial sector, and so on and so forth. Individual stocks, I just listed some examples, but some stocks that kind of caught my eye. Heavy machinery, so this kind of goes into the infrastructure. CAT means Caterpillar. So Caterpillar specifically has benefited from tariffs in the first term on Chinese machinery, and CAT actually increased by 15% their sales during the 2018 trade war. And this is the trade war in part, that we spoke about earlier in this video. Another one, Lockheed Martin. I am personally in favor of Lockheed Martin. So LMT, that's their ticker symbol, and their stock actually increased by about 50%, which is quite a bit, during Trump's first term as defense spending increased. So pretty decent company, and it has seen growth in the past. So assuming that these policies continue into the second term, we might be able to see some profit there. And then another company that caught my eye was Archer-Daniels-Midland. ADM is the ticker symbol here. And this is an agricultural producer. They produced, I think their earnings went up by about 30% during the COVID, or during 2019 into 2020. And they do produce quite a lot of groceries, foods, etc. for the United States. So also the reason why I listed this here is because it's from a recession-proof standpoint. Archer-Daniels-Midland might also help with proofing for recessionary periods, assuming that tariffs might cause the S&P 500 to continue to cycle downward and cause more volatility. Commodities is another one. So gold, a lot of folks have said gold might be a hedge against potential inflation. I think this depends on how you yourself approach volatility in the market. I personally see it as a buying opportunity. I have not really get dabbled too much in gold, but some people, this brings us to my fourth point, alternative currency, specifically crypto. So Trump policies in the past, specifically also what Trump has mentioned in past press conferences, has been more tilted toward crypto currency, possibly blockchain, etc. So that's why I listed just in general alternative currency. So Bitcoin being the main one, right, or one of the main ones, might see an increase in interest, an increase in funds invested, and even an increase in interest from the government in cryptocurrency, in blockchain, in Bitcoin. So these are some things that I would be looking at and trying to get ahead with my portfolio. And finally, before we wrap this up, risks and considerations. Obviously, market volatility will likely continue, at least during some periods, because there's geopolitical tensions and policy shifts, which we have very much been experiencing over the last couple of weeks. So make sure you're attuned to that. Trade wars, if there's a continued tit for tat type of trade war that we have seen in the first term, that might cause further volatility and other retaliatory measures from other countries. And then national debt, right? So of course we know that there is DOGE that was implemented, the Department of Governmental Efficiency, which is trying to combat the national debt due to rising deficits. But long-term economic deficits might persist. And the question is, how would these efficiency measures impact the market or not impact the market? So these are just some things to keep in mind. Hopefully, this video helps you, give you a very brief and a very quick understanding of what has happened in the past and what likely could happen, which sectors could possibly benefit from upcoming policies, or at least upcoming potential policies. So my goal for you is to start building wealth right now. And if you found this video helpful, please make sure you like and share to help others. Subscribe to my YouTube channel, which is at @_MMW for more cool insights. Hopefully you'd like that. And then of course, join my newsletter, very important, for exclusive tips. And of course, the link is in the description below. Your bank accounts will thank you later. Make sure you get ahead of this now while you can. Thanks so much.